Alright guys, so now let's go through the specific entry rules for impulse pullback. And let's begin with the long setup. Now again, what I'm going to talk about here, I've actually talked about already. So it's to formalize the specific entry rules that you got to follow for every setup. Okay. So first, we want to see a bullish signal from either the 6 EMA crossing above the 18 EMA or the MACD crossing above the signal line. Right. So either one has got to give you that bullish signal. Now, right after that bullish signal, you gotta have a swing high, right? So it says swing high must be right after the bullish signal. And right after the swing high, the next candle must be followed by a pullback or an inside bar, right? If it's not followed by a pullback or an inside bar, it's not a valid trade, okay? Right, so it must be followed by a pullback or an inside bar followed by a pullback, right? Remember that an inside bar itself, you can't take an entry. You have to wait for at least one pullback after the inside bar. Now, we can have a maximum of only 2 pullbacks. One inside bar alone is not reliable. Okay, so once you see that setup, you can enter, right? So for the entry, we place a buy stop limit order 3 to 5 cents above the last valid inside bar or pullback candle, and that is known again as the trigger candle. Okay, we then place a stop loss, which is a sell stop order just below that trigger bar, again 3 to 5 cents. Okay, the stop loss distance will be 1R, which is the difference from the entry price to the stop loss. That's 1R. We will then put a target price, which is a sell limit order 2.5R above the entry price. And again, I'm going to explain it with the charts in a short while. Now, besides that, there are a few low risk filters which I use because, you know what, every day you're going to see many of these setups, right? You may see 10 or 20 in a day. So I only take 1 or 2. So I like to filter to take the highest probability setups. So what do I look for to further filter down to take the best ones, the A quality setups? Well, first, ideally, if I'm going long, I want the medium-term trend to also be bullish. So how do I know, right? So basically, I want to see the 50 moving average above the 100 moving average, or above the 150 moving average, which again is above the 200 moving average, right? So I repeat, the 50 moving average above the 100 moving average, which is above the 200 moving average. Now, this is not a must, right? But it's nice to have because it tells you that the overall big trend is up as well, and that gives us better odds, okay? But I must say that sometimes I do enter a long trade even if the moving averages are sloping down, if the price gaps above all the moving averages. Okay? The important thing is that I want to enter above the moving averages because the moving averages act as resistance if you are below the moving average. So I do not want any resistance. If it's above, I've got no more resistance, clear skies ahead, I take that trade. Okay. Next, the next one is really important. Now, I do not want to enter if the company is going to announce earnings anytime soon. So if it's going to announce earnings in the next 7 days, I avoid taking that trade in case earnings don't go according to plan. Next, I want to ensure there's no significant resistance levels from the time I enter to hitting my target price. So the basics goes where you always draw your resistance and support levels, okay? And that goes for any kind of strategy. Next is also really important. Now, when I'm going long, I have to ensure that the MACD is always bullish. The MACD line must always be above the signal line. So even if the bullish signal comes from the 6 and 18 cross, the MACD must already be bullish. Okay, if the MACD is bearish, I will not take a long trade. That's really important. Okay. Next, if I'm taking a long trade, if I'm buying, I want to make sure the price is not overbought, it's not overextended. So how do I tell? Well, I look at the full stochastics and I look at the Bollinger Bands. So if the full stochastics is above 80 and the price is hitting the upper Bollinger Bands and they're both happening together, tells me it's a bit overbought. It's overextended, I will not take the trade. Okay? But if the stochastics is above 80 and the Bollinger Bands are nowhere near, then I may take the trade. Or similarly, if the price is hitting the upper Bollinger Bands, but stochastics is not over 80, It's fine. It's only if I've got both of them telling me it's overbought, I avoid taking that trade. So let's look at an example. This stock is VLTC, okay? And what you see is initially the price is kind of like consolidating below the 50 moving average, right? It's kind of like going sideways, and then boom, something happens, some good news, and the price gaps up. Now it doesn't have to be a gap up, but it happened to gap up, right? And when it gapped up, what happened? That's right, the 6 EMA crossed above the 18 EMA. So that's a bullish signal, right? So right after the bullish signal, we have our swing high. Why is it a swing high? Because it is the highest high than all previous candles, right? Now, right after the swing high, we must have an inside bar or pullback, which we get. We get a pullback, right? So what happens is after this, we have got some profit taking. So price makes lower highs, lower lows, we have a pullback candle. Can we take the trade? Yes. So we'll place a buy order a few cents above the high of the candle, and our stop loss a few cents below the low of the candle. So we buy over there, stop loss over here. The difference is 1R. So 1R represents our risk, right? What's our risk per share? So if we're risking 1, we want to make at least 2 or 2.5. So I usually put my target price at 2.5R above the entry price. I know it says 2 here, should be 2.5. So this is a buy stop limit order. That's my entry. That's my sell stop order. That's my stop loss. And that's my sell limit target price. Okay. Now, what happens the next day? The next day, the price, after going through a pullback, continues, right? So the next day, the price goes up above the high of this candle, triggers my buy order. I'm in the trade 1 day, 2, 3. In 4 days, I hit my target price. Okay. Now let's take a look. Were there any earnings coming up? Nope. So that's fine. Now notice MACD is bullish as well, right? So remember, MACD has to be bullish when you're taking a long entry, right? By the way, not only did the 6 cross above the 18, but the MACD also just crossed bullish. So in this case, we had 2 bullish signals happening at the same time, and that is what we call an A quality setup. Okay, great. Now what else can I talk about? Now, do note that the buy entry is invalidated if the bullish signal reverses. Okay, what does it mean? That means when a 6 EMA crosses below the 18 EMA, or the MACD turns bearish, the trade is invalidated and we have to cancel our order. Okay, or if we have got more than 2 pullbacks from the swing high, so swing high, pullback, another pullback, not valid. All right, so do take note of that. All right, so when I say a few cents above the high of the candle, a few cents below, I know I said 3 to 5 cents. So on average, it's 3 to 5 cents. Now, to be more specific, it depends on the price of the stock. So let me give you kind of like a rule of thumb I use, right? So basically, if I'm trading really low price stocks, like in this case, like $4, right? $4 stock. Now, if the price of the stock is below $5, I usually use 1 cent. In other words, I'll put a buy order 1 cent above the high of this candle and a stop loss 1 cent below the low of the candle, if it's below a $5 stock. If it's a $5 to say a $10 stock, then I'll use 2 cents as, you know, how high or low to place it. If it's between $10 and say $50, I use a 3 cent amount. Okay, 10 to 50 bucks. If it's $50 to $100, I will then place it 5 cents above or below the high. Okay, and if it's above $100, then I'll use 10 cents. All right, now this is just a rule of thumb. Okay, or roughly this is what I use. All right, so when I mention 3 to 5 cents, I'm really talking about most stocks which is between $10 to $100. Right, so again, it's below $10, I'll use 2 or 1 cents. If it's above $100, I'll use 10 cents, right? Okay, great. So let's look at the short setup entry rules. Now, it's the opposite. So when we're looking for short setups, we want a bearish signal from the 6 and 18 EMA. So the 6 EMA crossing below the 18 EMA, or the MACD crossing bearish, right? The black MACD line crossing below the signal line. So either one of that constitutes a bearish signal. So right after the bearish signal, we have a swing low, right? The swing low must come right after that bearish signal, okay? Now, right after that swing low, we need to have that's right, we need to have a pullback or an inside bar that makes a higher low, okay? So it needs to be followed by immediately by a pullback or an inside bar. But remember that if you have an inside bar, we can't take the trade yet. We have to wait for a pullback after the inside bar, okay? So minimum of 1 pullback, maximum of 2 pullbacks. 1 inside bar alone is not reliable, okay? So once you've got it set up, you can enter the trade. So we place a sell stop limit order, again 3 to 5 cents below the last valid inside bar or pullback candle. And that last inside bar or pullback is known as the trigger bar, okay? We then place a stop loss order, which is a buy stop order 3 to 5 cents above that same trigger bar. And the distance from the entry price to the stop loss is 1 hour. That's your risk per share, okay? And we place our target price, which is a buy limit order, 2.5 hour below the entry price. Okay, so I'll show you guys on the charts in a short while. So again, you may have many trades in a day, so I'm going to filter them to take only the A quality setups. So ideally, when I go short, I want the price to be on a medium-term downtrend as well. So ideally, the 50 moving average is below the 100 or the 150 moving average, which is then below the 200 moving average. So it tells me that we've got that downtrend EMA fan, which we talked about in that lesson of technical analysis. Next, no earnings release within the next 7 trading days. No significant support levels within 2.5 hour of the entry price. So of course, if we go short, we want to be able to hit our target price, which is 2.5 hour below the entry price. So if there's any strong support levels, we want to avoid those trades. So like any other strategy, you have to draw your support and resistance levels when you look at the chart, okay? When we go short, we always want the MACD to be bearish. So the MACD line must always be below the signal line, even if the signal came from the 6 and 18 EMA. MACD has to be bearish. Again, when we go short, we want to ensure the price is not oversold, it's not overextended down. How do you know? Well, if it's overextended, if the stochastics is below 20 EMA, and the price is hitting the lower Bollinger Band. So if they're both happening at the same time, I will not take that trade, okay? So let's look at a specific example over here. This is on Western Alliance. And over here, you can see that bearish signal, right? The 6 EMA crossing below the 18 EMA. And again, at that moment, we have our MACD, which is bearish, right? So MACD must be bearish when you see a short setup. So the moment you've got that signal, you have the swing low candle. That's the swing low candle, okay? Right after the swing low candle, the next candle must be a pullback or an inside bar, making a higher low. If the next candle does not make a higher low, it makes a lower low, it's not a valid pattern, right? So we do not trade that pattern, okay? So in this case, it makes a higher low, but it does not make a higher high. So it's not a pullback, it's an inside bar, right? So with an inside bar, we can't take the trade yet. We have to wait for a pullback. The next day, we get a pullback. We get a higher high with a higher low. So that's our first pullback. We can take the trade. So we'll place our sell stop limit order, right? In this case, be 3 cents below the low of that candle. That's our entry price. Stop loss would be a buy stop order, 3 cents above the high of that candle. So this distance would be 1 hour. That's our risk per share. So our target price needs to be at least double or 2.5, right? Usually I use 2.5 hour for this strategy. So our buy limit order would be somewhere over here. The next day, the price goes below that low, it is triggered, right? So 1, 2, 3, 4, 5, 6. Within about 5 to 6 days, we hit our target price, right? So that's a short setup, previous was a long setup, okay? Now, as I mentioned earlier on, ideally when taking a long entry on a short-term uptrend, we also want the medium-term trend to be on an uptrend ideally. Now, this is not a must, it's a nice to have. So I've got a few trades to look for, I'll choose this one, okay? This gives us the highest probability of an upward move and no moving averages act as resistance, okay? So in this case, you can see the 6 EMA crossing above the 18 EMA. Can you see that signal? This is a bullish signal, right? And right after that, we have got a swing high candle. That's my swing high candle. And right after the swing high, we have got a pullback, right? That's my pullback candle. So my buy entry would be a few cents above the high of that candle. My stop loss will be below that candle. Next day, the price goes up, triggers my buy order, and boom, I'm in the trade. Okay, so notice that at this point when we take the entry, the 6 EMA is above the 18 EMA, telling us it's a short-term uptrend. But at the same time, we are above the 50 moving average, which is this blue line. The 50 moving average is above the 150 moving average. Now again, you can use the 150 or the 100, doesn't matter, right? And it is then subsequently above the 200 moving average. So we have got that 50, 100, or 150 and 200. So it's a clear uptrend. That's what we want to see, ideally, okay? And again, when we're going short, we want the medium-term trend to be down as well, okay? So in this case, you can see 6 EMA crossing below 18 EMA. That is a bearish signal of a short-term downtrend. Right after that signal, we have got a swing low, okay? We have an inside bar. We can't take the trade yet. We then have a pullback. So put our entry just below this candle. The next day, it doesn't get triggered. We have another inside bar. We raise the entry to below this candle. The next day, we get another pullback. So we have got 2 pullbacks and 2 inside bars, all right? So ultimately, our sell order will be below this last candle. Our stop loss is above that. Next day, price goes down, triggers our order, and we are all the way down, okay? So notice that as we take the trade, we are below the 50 moving average, this blue line, and it's below the 150, the green line, below the 200. So again, we are below all the moving averages. There's no support all the way down. And that's what we want to see. That's the ideal trade. All right, guys. So now that you understand the specific entry rules for the long and short setups, I'm going to show you what I consider A quality setups or very high probability setups. So like I said, on any given day, you may find many valid setups. Okay, you might have 5 or 6 in a day, possibly. But I may only take one of them or none of them at all because they are not high probability. So what do I consider high probability? Well, again, these are the rules. For long trade, okay, it has the highest probability of success when 3 things happen on the same day. All right, what are the 3 things? Number 1, the 6 EMA crosses above the 18 EMA, okay, and the MACD crosses above the signal line, and the price crosses above the 50 moving average. So again, if 2 out of 3 of these conditions occur at that same time, which means on that same day, now I'll give a 1-day buffer, right? But more or less should be on the same day, then this impulse property trade has a high probability of success. Again, in addition, the price upon entry should not be overbought. In other words, the stochastic should not be above 80 and the entry price should not be hitting the upper Bollinger Bands. And I'm going to show you a number of charts to, again, visually explain what I'm talking about. So for short setups, it's the opposite, okay? A high probability short setup is one where, again, 2 out of 3 of these conditions, right? Number 1, the 6 EMA crossing below the 18 EMA, and the MACD crossing bearish, and the price crossing below the 50 moving average. So once again, any 2 out of 3 of these conditions happening at the same time, which means on that same day, 1 day buffers, fine, has a high probability of success. So in addition, the price should not be oversold when you're shorting. So ensure stochastics is not below 20 and your entry price is not hitting the lower Bollinger Bands. So let's take a look at some examples of what I consider such trades. Okay, so on MHK, you can see that over here the 6 EMA has crossed above the 18 EMA on the just after the 7th of May. Can you see that? Okay. Now at the same time, you can see that the MACD has just crossed bullish. The MACD line crossed above the signal line, and it happened. This happened on 7th of May. This happened on 7th May. So it's actually the same day, right? So these two happened at the same time on the same day, right? At the same time, you can see the price was below the 50 moving average, right? And what happened on the 8th of May, right? The price gapped above the 50 moving average. So again, it happened on that same day, more or less. 1 day buffer, give or take a day, right? So we have got these 3 things occurring at the same time. That's what I'm talking about. So that's a high probability entry, okay? So the moment you've got that cross, we have the swing high candle, okay? So once you get a swing high, you've got an inside bar, all right? Can you enter on the inside bar? No, you have to wait for at least 1 pullback. So after this inside bar, you get this pullback candle. And notice that this pullback candle is resting on the 20 EMA. It's kind of like sitting on the 20 EMA. Now that's another thing which I love to see. When the pullback is finding support at the EMAs, the moving averages, that gives me added confidence that it will move higher, all right? So we have got this pullback. Can we place our buy order? Yes, our buy order is placed, in this case, 10 cents above the high of this candle, since it's a $180 stock. The next day, does the order get triggered? No, because the next day, you have another pullback, right? So pullback, right? Lower high and lower low. So now we cancel this order and place the new buy order above the high of this candle with the stop loss below the low of this candle. Okay, and you can see that at this point, the stochastics, right, is below 80, so it's not overbought. And the entry price is also pretty far away from the upper Bollinger Band, so telling us that it is not overbought yet. Okay, so that would be a good entry. So the next day, what happens? The next day, the price exceeds the high of this candle. It gets triggered, and I'm long. Okay, and it goes 1, 2, 3, 4, 5, and it goes all the way up, hitting my target price. Again, notice that upon entry, the MACD is also bullish, which is one of the conditions. Yeah. Okay, NCLH. Let's take a look at this example. So again, on the 7th of May, we have got the 6 EMA crossing above the 18 EMA and the MACD crossing above the signal line. So they both happen on the same day. Okay, and you can see that the price from being below the moving average, the 50, has now crossed above the 50 moving average on that same day again. So again, 3 out of 3 conditions happening on the same day. That's what I'm talking about. Okay, so we have got our swing high candle over there. The next day we have is it a pullback? No, it's an inside bar, right? Inside bar. So can we place our order? No, we can't. We have to wait for a pullback. So after the inside bar, boom, we get a pullback, right? So our buy order will be, in this case, a $50 stock. So we could put it at 3 cents, 3 or 4 cents or 5 cents, right? Above the high of this candle, the stop loss below that. The next day, what happens? It doesn't get triggered because it makes a lower high. Okay, so it's another inside bar. So now I shift my buy order above the high of this candle, and my stop loss can remain at the low of that pullback candle. Okay, so enter there, stop loss over there. Next day, the price exceeds the high, I get triggered, I buy, and I'm in the trade. Pretty straightforward, right? Again, MACD is bullish when I'm entering. When I'm entering the trade here, you can see that, again, it's not near the upper Bollinger Bands, and stochastics is still below 80, right? So it's not overbought. Here's another one. Now here's a short setup. Okay, we're going short. So on the, let me see, 7th of January, the 6 EMA crossed below the 18 EMA. Okay, and the MACD crossed bearish on the 8th of May, 8th of January, right? So it was a 1-day buffer. So like I said, you can give a 1-day buffer, but more or less it should be happening at the same time, right? So 6 has crossed below 18, MACD has crossed, both happen at the same time. Okay, so we have got that swing low candle right at that cross. We have got a pullback, and again, I love this pullback. Why? Because again, it's finding resistance at the moving average. All right, so when I'm going short, I like the pullback to find resistance. If I'm going long, I want the pullback to find support. And not only that, can you see that this pullback candle is a bearish pin bar, right, with a long upper shadow, which is a bearish signal. Perfect. Okay, so my sell order will be in this case a $12 stock, so I could put my sell order something like 2 cents below the low of this candle. My stop loss 2 cents above. All right, the next day it goes lower, triggers my sell order, and I hit my target price in 2 days. Perfect. VLTC, okay, 6 EMA crossing above 18 EMA on the 31st of April or May. MACD crossing on that same day. So again, 2 out of 3 happening at the same time. And the price, again, from below the 50 moving average goes above the 50 moving average. So again, we've got 3 out of 3 conditions happening at the same time. We just need 2 out of 3, but 3 out of 3 is even better, right? So right at that cross, we've got a swing high candle, and we have got a pullback. Can we take the trade? Yes, we can. So once again, buy order. This is a very low price stock. So buy order 1 cent above the high of this candle. Stop loss 1 cent below the low of this candle. Next day, price exceeds the high, gets triggered all the way up. Beautiful setup. Okay, next on VDSI. So let's take a look on the 9th of April, I think it is. 9th of April, yeah. So 6 crosses above the 18 EMA. All right. And on the 10th of April, you can see that the price crossed from below the 50 moving average to above the 50 moving average. So again, that's a 1-day buffer. But basically, both of them, 2 conditions are happening at the same time. Now, the MACD has crossed quite a number of days ago, so that's not included in the 2 out of 3 conditions because it must happen on the same day with a 1-day buffer maximum. All right. So 6 crosses above 18. Right at that cross, we have got the swing high candle. Right after the swing high, we have got an inside bar. Again, can we take a trade? No, we can't. We have to wait for a pullback. So the next day, we get a pullback, making a lower high and a lower low. And again, why do I love this pullback? Because it is finding support at the moving averages, right? And it's a bullish pin bar, okay? What else do you want in life? So our buy stop limit order will be something like 3 cents above the high of this candle. Now stop loss will be 3 cents below the low of this candle. Next day, price exceeds the high, we get triggered, we are in the trade, and we write the trade up. Okay? And notice at that point of time, when we enter the trade, the MACD is bullish, which is one of the conditions. MACD must be bullish for long setups, bearish for short setups. I can't emphasize that enough. Okay? Another one, Drew Industries, DW. Okay? So what has happened over here? 11th of April, or May in this case, 11th of May, 6 crosses above 18 EMA. Okay? MACD cross on the 8th of May. Okay? So MACD cross over here, 6 cross 18. Let me take a look. It's more or less a 1-day buffer. Okay? So right at the cross, we have got the swing high. We've got an inside bar. Sorry, we've got a pullback. Again, pullback's a bullish pin bar resting on the moving averages. So that's an ideal kind of pullback. So our buy orders up there, stop loss over there. Next day, we get triggered in the trade. And we take the trade up as we go. MEI. This is a very nice one. So again, 6 crosses above 18, MACD crosses. So we have got 2 out of 3 conditions happening at the same time. All right. Right after the cross, we've got a swing high candle. We've got a pullback. Again, beautiful pullback. Lower high, lower low. Bullish pin bar. Finding support at the moving averages. Okay. So buy order 3 cents above the high. Stop loss 3 cents below the low. Right. $40 stock. Next day, price goes up above the high, triggers our order, and we are in the trade. Here we go. All right. So to summarize, all the things we need to look for, right, to take a low risk entry. Number one, 2 out of 3 conditions should be happening on the same day or a day buffer at the most. What are the 3 conditions? 6 EMA crossing above the 18 EMA, MACD crossing the signal line, and the price crossing the 50 moving average. Number one. Number 2, ensure there's no downtrend resistance for long setups and uptrend support for short setups. So like in any other strategy, you always want to draw support and resistance levels. And if there happens to be a major resistance level, near your entry, don't take it. Right? If you're going short, make sure there's no major support level. Okay. Again, mentioned before, MACD must be bullish for long trades and bearish for short trades. Okay. Entry price should not be overbought for long trades, as in not hitting the upper Bollinger Bands. Stochastic should not be overbought above 80. For short trades, stochastics not below 20. Price not hitting the lower Bollinger Bands. Right. So these are the summary of the low risk filters. Always follow them exactly to the T. Right, so let's talk about risk and trade management for the impulse pullback strategy. Now, the risk and trade management is exactly the same as for the bounce strategy that you learn in level 1, because the impulse pullback is also a trend following strategy. Okay, so just like the bounce strategy, we set a fixed target price and a fixed exit price. So when we enter the trade, we have a fixed target price of at least 2R or up to 2.5R. So again, if we can hit 2.5R, we go for 2.5R. But if we find that there's a resistance level before 2.5R, we can set our target price at least 2R. So we want to risk 1 to make at least 2 to make it worth our while. And again, once we're in the trade, all we got to do is to shift our stop loss to the entry price once the stock moves 1 hour in our favor. And once that happens, we just leave it and allow the trade to hit our profit target or the stop loss price. So we either get minus 1R, 0R break even, or 2.5R profit target, or 2R in certain cases. Okay. And again, always watch the earnings date and always exit before earnings is released. And again, as I said previously in the previous lesson, if you like to exit the trade after a couple of weeks, if it has not hit the profit target or the stop loss and it's taking up a lot of your cash or funds, you'd like to exit the trade to take on more trades, you can do so as well. But if you want to do that, have a consistent rule that says, okay, if the trade is not does not hit the profit target or the stop loss within 4 weeks, for example, or 3 weeks, I will exit the trade. And again, you can always do that. Yeah. All right. So that's it for risk and trade management. It's pretty straightforward. Follow the exact same rules as the bounce strategy.